Today, rates up, rates down, rates sideways. Who can tell? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by Peter Marshall from Mozo. Hi, Peter.
Hey, Martin.
Great to have you back on again. And you've just interestingly released some information just ahead, of course, the Reserve Bank meeting tomorrow, which is suggesting we should be very cautious about where interest rates are going.
Yeah, we've already started to see fixed rates shift. So, the pattern has generally been so far that longer term rates are being pushed up. While some shorter term rates are following, there are also some lenders that are still cutting those shorter term rates.
Right. And one of the things that's a change, of course, is the Reserve Bank term funding facility, which was the ultra cheap money that the banks were receiving from the Reserve Bank. That basically ended at the 30th of June. And that could put some pressure, I think, on some rates ahead.
Yeah, I expect, the banks seem to have lots of term funding facility left available to them as we came up to that end date, but they drew it down very quickly in the last few weeks. So I think that what we're going to see is a long period of the banks using up that very cheap funding and starting to switch over to their more normal funding sources, which of course are more expensive.
And those funding sources would include, obviously, deposits. So we might see some uplifts of some term deposit rates, but they can also access the international capital markets, the financial markets. But both of those would be probably a little bit more expensive than that ultra cheap money from the Reserve Bank.
Oh, for sure, yeah. On the deposit market, even the worst at-call savings accounts are sitting around sort of 0.3%, while some of the better ones are still up around 1%. So those deposit funds are obviously more expensive. But yes, going overseas doesn't help either. It's very hard to find countries that have got rate settings as low as we have.
Right. So what that suggests then is that prospective borrowers should look quite carefully at the current offers that are around. Some of them are still, as you say, pretty good, with the assumption possibly that the very cheap rates that are around at the moment might not last for that much longer. But I suppose also the question is, the very cheap rates, when you next come to refinance, probably will be quite a lot higher.
Yeah, look, that is difficult with fixed rates. And I think if you're going to commit to a fixed rate, it can be great to give you a period of stability where you know what your repayments are going to be. But you do need to be ready to take action at the end of that fixed term, because the variable revert rates on these products can be incredibly high. So if you just let your loan roll over to those, you could end up paying a lot more than if you'd never switched to a fixed rate.
And I guess one of the points to make there is that with rates so low, the amount you're actually paying back on the interest side of the equation, is actually relatively low, which means that if rates do go up, then those payments can move up quite significantly.
Yeah, the interest repayment accounts for a huge amount of your monthly repayments. And that gets worse as rates go up. So, yeah, any increase in rates, it doesn't take much to really shift the equation and mean that you've got to find significant extra money each month.
And what are you seeing with regard to the main lenders, the big four banks versus the regional banks versus some of the non-banks? Are there significant variations?
Yeah, look, the big guys are actually still playing very competitively. If you're looking at the big banks, the big four, their 2-year terms, for example, are still all a tad under 2%. Other terms are around just over the 2% mark, but for 4 years you're getting up towards 2.5%, and for 5 years is as high as 3% with Commonwealth Bank. So it's a huge difference depending on which term that you choose to lock in for. Some of the smaller players are undercutting those rates, but not by much. For example, I said, the 2-year rates for the big guys are just under 2%. One of the small lenders in the Mozo database, they're called BCU, is at 1.78% for 2 years. And you can get rates like that for up to 3 years if you look around.
So the message, of course, as always, is shop around. Don't just jump at the first thing that flies through your internet portal or, wherever else. And it does tend to be the case that some of the smaller organisations are still relatively more competitive.
Yeah, they're competing really hard for deposit funds as well. They're offering better deposit rates than the big banks do for the most part. But it's great to see them also competing really hard on the home loan rate front.
And one other question, which is this: do you think those rate movements are indicative of anything in terms of longer term rates? Is it likely that we're going to see rates continuing to rise ahead? I mean, the Reserve Bank is saying no change to the cash rate until, 2.5 years, 3 years out. But can we really take that as gospel, do you think?
Yeah, that's really interesting. Right now there seems to be a huge disconnect between what the Reserve Bank thinks and what the bank economists think. The bank economists are tipping rate increases to the cash rate before the end of next year. So, with the RBA saying, no, it's going to be another 2 years beyond that, there's a building gap between those two forecasts. The experience that I've had over the years is that the banks tend to be a bit closer to the truth than the RBA. But regardless, they'll be pricing their loan portfolios according to what their view of the future is for interest rates. So if they think that if the rates are going up in the next couple of years, anything beyond that will definitely have a lot of price pressure put on it.
And I think that's a really important point, right? Because the Reserve Bank is essentially, jawboning the rate and controlling the 3-year rate through its yield control. But what's called the implied forward rate, which is the difference between short-term money and long-term money, is the thing that ultimately is driving a lot of the pricing from the banks, right? And if the implied forward rate out there is going up, then you can be pretty sure that the treasury operations within the banks, and therefore the bank economists, will have their finger on this pulse, because if they get it wrong, it can be significantly high risk for them in terms of profitability.
Yeah, absolutely. And, I think that's one of the reasons why, things like cashback offers are really abundant at the moment. You can get, $3,000 cash back for switching your loan really easily right now. And they're great things for the banks because they know what the cost of that is. It's a one-off cost. They pay it up front. There's no risk going forward. So that takes part of the acquisition strategy out of their pricing process and allows them to just focus on where they think rates are going to be. But yeah, I think that over the next 6 to 12 months, we're going to see all those longer term rates go up significantly, and probably the start of the shorter term fixed rates heading north as well.
Right, so the moral of that story is, folks, there's no such thing as a free lunch. So if they're going to give you a cash back, there's a reason why they're doing it. And the second is that you should be planning ahead. And I always say to people, you should be not saying what's the repayments now, but what would the repayments be in 2%, 3% higher, because you need that wriggle room, particularly if you're on a variable rate, because if variable rates do start to grind higher, then it could happen quite quickly. And all the experience looking up over the last 20 years is that rates, once they start going up, tend to go up much quicker than the slide down.
Yeah, that's a really good point. And it's great that you're highlighting this for borrowers, because there are a lot of new borrowers out there who haven't been in the housing market before. They haven't been watching interest rates. I think it's kind of an edge sport for some of us. But yeah, if you're not used to seeing what rates can do, there could be some big shocks ahead, and people should be really cautious about how much they're borrowing and what their forward commitments look like.
Absolutely. Well, as I keep saying, make sure you have a cash flow, make sure you understand what you're committing to. Don't just assume just because the bank says you can borrow the loan and it's fine. They haven't done the maths on the same basis as you might have done. And at the end of the day, of course, they're scot home free because basically they've got that protected equity, right? You're the one who have to make the repayments. So it's always really important that people do their due diligence, check out different lenders, and of course, the Mozo database is a really good source to be able to go and compare different lenders with different products so that you can actually get to find some of the best deals, because there are big differences.
Yeah, look, I always think that it's a great idea to check out your options, but also consider things like splitting your loan so you can take advantage of some of the great low fixed rates that are around right now, but also leave yourself exposed to some variable rate movements. That way, you may not get the optimum outcome, but you're certainly decreasing the risk of being caught in a loan that you can't afford in 5 years' time.
And I think that's important advice, which is it's not only the cheapest, but it's also about protection, right? Particularly if you know that if rates do go up, you're going to have difficulty. There are ways of building some protection in. So indeed, loan splitting is often worth considering. Peter, I really appreciate your time today. Good to catch up with you again. I'll put some links and things to Mozo below. And I'll look forward to picking up the conversation as things continue to develop, as they will, no doubt.
Yeah, well, looking forward to seeing what the RBA does next.
Yeah, who knows. Good to talk to you. Thank you so much.
Thanks, Martin.
Cheers.